All right, so let's begin. Good afternoon, everyone, and welcome to our Building Wealth program. We'd like to start by introducing ourselves. My name is Malen, and we also have Alexis with us today. Before we get started, we wanted to go over some Zoom features. Your mic and video have been muted and turned off. You'll be able to use the chat feature, which is located at the bottom of your screen. If you select the chat icon, a box should pop up over to the side. If you have any questions, we do ask that you type it into the chat, as we'll have a Q&A at the end of the presentation. In today's presentation, we are going to look at how you can build wealth and set yourself up for financial success. There are 5 steps to building wealth. The first is that you need to learn the language. The second step is to budget to save. The third step to building wealth is save and invest. The fourth step is to build credit and control debt. Lastly, the fifth step is to protect your wealth. Before we get started, we wanted to state that the views expressed do not reflect official positions of the Federal Reserve System or the Plano Public Library. This presentation is for information purposes only. It is not intended to be investment advice. Seek a licensed professional for investment advice. And tying into that last point, again, just to reiterate, we're not experts. Rather, this presentation will serve as an introduction. Some of you might already have this knowledge and some of you might not. Hopefully, you can walk away from this presentation with one piece of information that you can implement into your building wealth strategy.
All right, we'd like to get started by telling you a little bit more about the Building Wealth curriculum. The Federal Reserve Bank of Dallas created this resource about 20 years ago because studies discovered that the lack of personal savings and good credit were preventing many people from reaching their goals to buy a home or start a business. There is a need for families to build financial capability and resilience. We know that financially stable households make for a more stable economy overall. Building Wealth is one resource for people from high school age to adults to help work towards financial stability. The Federal Reserve in Dallas provides this resource in print for free. And it's also designed as an online guide with built-in calculators, which has become one of our district's most popular resources. You can access it by going to buildingwealth.org. What does financial capability really mean? Financial capability is having the knowledge and tools to manage your money. We don't teach financial education just to check off a box. The materials here will help you to make positive changes in your life. Financial education is nothing without behavioral change. Putting action to our dreams is what makes them a reality. Don't get overwhelmed with the big picture. Small changes can lead to big results. And focus on a few small changes you can make this year. Then you can add a few more changes next year and build from there. A few small steps that can lead to big results. That's a good approach that we take with building wealth. Our very first step in this process is to ask, what does building wealth mean to you? Some people might define wealth as being able to live in an expensive house and travel around the world. Some of us just want to help put our kids through college. Some of us might want to have peace on this issue in our lives, some peace of mind, instead of always worrying about money. It's totally based on everyone's own personal values and life experiences. So now that we've defined wealth, how do you acquire it?
So to create personal wealth, you must understand the language. So the first step is to understand the meaning of assets, liabilities, and net worth. An asset is anything an individual or business owns that has commercial or exchange value. For example, a retirement plan, stocks and bonds, or a house. Liabilities are your debts, so what you owe. This may be your home mortgage, your credit balances, a car loan, student loans, or medical bills. Net worth is your assets minus your liabilities. A simple equation to help you remember is that your assets, again, minus your liabilities equals your net worth. Here's an example that illustrates the assets minus liabilities equation. So the market value of a home is an asset. The mortgage is a liability. Let's say your house is worth $120,000, but your mortgage is $80,000. That means your equity in the home is $40,000. So equity contributes to your net worth. Balance sheets are excellent in helping you towards reaching your goals. Here's a sample of a balance sheet. I'd like to point out the assets, liabilities, and net worth. The website buildingwealth.org contains an online guide with a built-in calculator that you can play around with. The key thing to remember is that your net worth is your wealth.
In this section, we will demonstrate how you can budget in order to save. Most people who have built wealth don't do so overnight. They got wealthy by setting goals and pushing themselves to reach them. Setting financial goals can help you when it comes to setting a budget and saving for your future. Goals are why you are making a budget and sticking to it. A strong why will help you when you have to make those small day-to-day decisions. So, what are your short-term and long-term goals? Think about what some of your own goals might be. A short-term example can be pay my bills on time each month or put money towards my rainy day fund. A long-term goal example can be to pay off my car and be debt-free in 5 years, or save for substantial down payment on your first home. It's okay if you can think of anything while we're going through this presentation. You'll start to figure out a few while you're going through the budgeting process on your own. Next, we'll discuss some strategies to meet those goals. This is Gabby. She's our example throughout the presentation. Gabby thinks she's doing pretty well and that she has a pretty good income, but she manages to spend it all and then some. Here we see her shopping, the sales receipts flying out of her shopping bags, a $5 latte in hand, and listening to tunes on her smartphone. As we go through this budgeting to save process, Gabby will realize she's basically living paycheck to paycheck. So we want to ask you, when it comes to you reaching your financial goals, are you doing or wishing? The difference is doers put actions to their goals, and they're much more likely to reach their goals and achieve their dreams. If you're a doer, you are more likely to track spending, live within your means, stick to a budget, pay off all credit cards in a timely way, deposit money into a savings every month, and make regular contributions to retirement savings. So, building wealth and financial freedom requires that you begin to track where your money is going, set up a budget, and make some small changes to begin to save. Here we have an example of David's day-to-day spending. You can see that everything is listed out, whether it's a large expense or a small expense. Tracking your daily spending habits is a very important first step to creating an accurate budget and the only way to really know where your money is going. So when you start making your day-to-day spending list, make sure you include purchases made with cash, debit card, check, or charge or credit, as well as the money that you might spend through services like Venmo, PayPal, and Apple Pay, among others. If you're doing this off the top of your head, you can probably write down a few things like your monthly bills, house payment or rent, a car payment, your wireless bill, utilities, etc. And you probably know about what your take-home pay is every month. We have these income and expense numbers right off the top of our heads, but it's not enough information to have in a real budget. You have to track all of your spending first. So write down your budget using a template found on buildingwealth.org. You can also create a spreadsheet or use an app. The trick for this is you have to write everything down, even if it costs you 25 cents. You only have to do this for a month or two to see where your money is really going. If tracking your day-to-day spending sounds overwhelming, here's an option. Start small and track all purchases for a week to get motivated to really start budgeting. So this here is an example of Gabby's monthly budget. As you can see here, we have her different areas on her budget here. We have take-home pay, overtime pay, pension, alimony, other income, and it's listed here in the total income bracket down here. She also has her expenses listed, such as rent, renter's insurance, utilities, all the way down. And we see down here her total expenses at the bottom. And we can see that her net income, so income minus expenses, does tend to be in the negative in her current budgeting. But once she moves to that new budgeting, hopefully it'll be in the positive. So as you can see, she is planning to make some small changes to her lifestyle to help build her wealth, as seen in the spending changes column. She increases her income by getting in some regular overtime, which adds about $40 a month, and she cuts back on her premium cable TV, clothing spending, and running around money she spends on gas and eating out. So you can see here from the new budget that she's developed a system that will enable her to save about $125 a month, and that's a budget she can live with. Here's another example. This is Sam's budget. Sam is someone who lives and works in Plano. Sam is single and lives in a one-bedroom apartment by himself. He makes about $16 an hour, and these are his actual living expenses. Since he's doing his own budget, he has realized he needs to make a little bit more money, so he's working overtime when he can, and he's creating digital content for his friends to make additional money on this side. So when Sam really started looking at his budget, he decided he needed to find a less expensive apartment. He only needed one TV streaming service, so he dropped Hulu. He didn't need to spend as much on clothing. And he could probably figure out a way to entertain himself less. And besides, he's a little busier with the extra job and overtime. So as you can see here, from taking his current expenses and making those spending changes, his budget uses small changes to help add to his larger goal. The same is true for you. Making a lot of small changes can add up to reaching your goals.
Step 3 in building wealth is to save and invest. Here's a tip from Dwight R. Lee and Richard B. McKenzie, the authors of Getting Rich in America. Take the power of compound interest seriously and then save. The investment pyramid is made up of several parts. At the bottom, you have your financial foundation. Next up, you have short-term holds, which is money that might be needed within the next 3 years or that must be easily accessed. Above that, you have medium-term holds, which is money that won't be needed for 3 to 5 years. Next up, you have long-term holds, which is 5 years or longer. And at the very top, you have high stakes. The important takeaway here is the foundation. So what is included in a strong financial foundation? You have your financial plan, and then you have your insurance. With regards to a financial plan, we'll want to know our net worth. We need to set goals and make a budget. Have our financial records in order, which means you have your records organized, and you keep the papers that you need, and you shred the papers that you don't need to keep. Financial records also includes keeping records for income taxes, keeping a copy of your tax receipts and tax forms, checking your credit report every year so you can watch for identity theft, and keep your credit in good shape. It's smart to have a strong foundation before you start investing in higher risk return investments like stocks. Other important elements to your foundation are your insurance policies for peace of mind. So things to consider beyond your foundation are things like financial goals, financial risk tolerance, inflation risk, time horizon. With regards to the investment period, with regards to the investment pyramid, the first layer above the foundation should be money that might be needed within the next 3 to 5 years. So this is money you're not going to want to keep. You're not going to want to take much risk on. So you'll want this in an FDIC insured savings account, savings bonds, or other accounts that you can get to when you need it. These insured accounts are no risk, but at the same time, low return. For your long-term savings, you'll want to invest in a little higher risk so you can get a higher return. At this point, you'll be ready to talk with an investment advisor and start making deposits to a retirement account or 401k if your employer offers one. Once again, just to reiterate the statements made at the beginning of the presentation, we are not experts and don't give investment advice other than to do your research and speak with a licensed financial professional. The reasons for using mainstream financial services. So this may be basic information that you already know, but an excellent first step is getting a basic checking and savings account started at a bank or credit union. So let's talk about some of the reasons for using a bank or credit union. Without a savings or checking account, managing your money can get expensive. Paying for check, cash, and fees, and buying money orders to pay bills. You can keep your money safe. For example, a savings account at a financial institution is fully insured by the Federal Deposit Insurance Corp of up to $250,000. You can take advantage of direct deposit, monitor your balance online, access your money from anywhere. Also, building a good banking relationship, which is an important part of your credit history. Financial institutions offer a variety of insured savings accounts, each of which pay a different interest rate. You have your general savings accounts, which earn interest and allow access of funds at any time and movement of money from account to account. Money market accounts earn interest. They may offer check writing services and impose no fees with a minimum balance. And you have your certificate of deposits, which are purchased for a specified term and return principal and interest at the end of the term, but there are early withdrawal penalties that may apply. So here are a few tips when it comes to investing your money. Find good information to help you make informed decisions. Make sure you know and understand all the costs associated with buying, selling, and managing your investments. Beware of investments that seem too good to be true. They probably are. And investigate financial professionals before you invest. Your state securities board provides free services to check credentials. Once again, the state securities board provides an easy way to check out financial professionals before you invest. A lot of people who are victims of financial fraud and scams probably didn't have all the information needed to make solid investments. Some people present themselves as financial professionals and they're not. Some aren't even registered, or in many cases are under investigation or have been charged with violations. So it's always important to do your research before you invest. Again, each state's securities board provides this service for free. Anyone who sells any kind of investment in Texas, for example, whether they're based here or not, is required to be registered here. And the Texas State Securities Board checks their background in a national database and verifies their credentials are up to date. You can learn more about this on the Texas State Securities Board website, which is www.ssb.texas.gov/investors, or search financial brokers using brokercheck.finra.org. Now, these links that I just mentioned will be provided in a slide at the end of the presentation, along with additional resources that you can explore further. So other investment options include employee benefits such as IRAs and 401ks and qualified plans. These are ways to save for retirement while paying lower income taxes on your current year's income or minimizing the impact of income taxes later, depending upon the type of investment. When it comes to employee benefits, check with your employer to find out what retirement plans are offered. Many employers will match a percentage of your contributions towards retirement accounts and or investments. If that is the case, you should put the maximum you can towards those accounts. It is a great way to increase your savings for the future. Two other investment options include investing in your home and starting your own business. With regards to investing in your home, one strategy is to pay higher monthly payments on your mortgage. And when you do so, your home equity rises. Home equity in this case is the difference between the market value of the house and the balance on one's mortgage. Another strategy is to take a 15-year mortgage rather than the traditional 30-year mortgage loan. With regards to starting your own business, use your skills to make money and have it be part of your strategy to build your wealth.
So now you're budgeting, saving, and investing to build your wealth. What do you do to build your credit? How do you build your credit? The important first step is to know what's on your credit report right now. Even if you haven't used credit in the past, you might have information on your credit report and it might be incorrect. Your credit report shows everything about your payment history, such as late payments, and lenders use those credit reports, credit scores, and other information, such as employment history and income history, when making the decision to extend credit to you. So, what are the ways you can make sure to have a payment history? You can do that by building your credit. For example, you can pay for gas for your car and any tolls on your credit card, and then pay it down or off every month. This helps to create a payment history and helps you to utilize the credit card without spending an excessive amount of money. You can buy groceries on your credit card or pay monthly bills. The important thing to remember is that you want to pay it down or off every month. Don't spend money that you don't have. Reviewing your current credit report is an immediate action step that you can take this year to get the ball rolling on achieving your goals. There are three major credit reporting companies, and each typically have the same information since most creditors report to all three. www.annualcreditreport.com is the only legitimate source for your free credit report, and it is authorized by federal law. Do you remember the definition of net worth or wealth? It is assets minus liabilities, which equals net worth. So liabilities are debts, debts reduce net worth, and interest paid on debt is not invested or saved. It is money that is gone. Therefore, it's important to control your debt. So, what is a credit score? A credit score is a statistically generated number representing the likelihood that you will repay on time. The higher the score, the less risk you represent to the lender. Your credit report is used to build your credit score. A credit score is not free, but some banks and credit companies do provide free credit scores with their account service. It's a good idea to check your score before you apply for a loan to find out if your score is eligible for the best interest rates. If the information on your credit report is accurate, then your score is accurate because it's based on information from your report. So, what's included in a credit report? The most important aspect of a credit report is your history of payments. Were your payments made on time or were they late? If your payments are late or delinquent, this will lower your credit score, which means you'll probably have to pay higher interest rates or even refusal. Another aspect of your credit report is the amount owed on credit accounts, which affects your score. Now that you know what's included on your credit score, let's briefly look at what's not included. Your credit score does not include your age, race, or ethnicity, income, job, marital status, education, length of time at your current address, and whether or not you rent or own. The Federal Reserve Board of Governors publishes a guide, and there's also great information on the ftc.gov website, which includes a sample dispute letter to send when you find a mistake on your credit report. So once you know the score, there are ways to improve or repair damaged credit, or establishing credit for the first time. Please note that a recent credit history is more important on your credit score than old credit history. One option might be a secured credit card, which is a good idea for building credit. It'll require a deposit, usually equal to your credit limit. After 6 months or a year at the most goes by, the secured credit card company will return your deposit and your secured card becomes a regular credit card. Some people confuse these with prepaid cards, but prepaid cards do not build credit. Another type of starter account might be a retail store card or a gas card. Make sure the card provider will report your payments to the credit reporting companies. We know that credit is a good tool to have, but always ask yourself if you're ready to take on a new credit obligation. You want to have credit if you ever need it, but is it better to save for some purchases like a TV? These are good questions to ask yourself. Always think about the pros and cons of financing a purchase. Here are some quick reminders on building good credit. Develop a budget and stick to it. Getting a new credit card does not mean you have more income. Save money so you're prepared for a rainy day. 3 to 6 months of living expenses are recommended. Pay your bills on time. Keep your credit card balances low or aim to pay them off monthly. Check your credit reports annually and dispute any incorrect information. Building wealth requires that you take steps to control your debt. Beware, all of us have an occasional financial emergency, such as the car needs new tires or the car needs to be retired completely. We have some warnings about high cost credit and predatory lenders. Payday advance loans are loans that many people who don't have emergency savings or who don't have credit available on a credit card or don't have family and friends to go to a loan for naturally think are their only alternative. These generally have many extra fees, higher interest rates, typically in the double digits, and they tend to get out of control and deeper into debt if they're not paid in full on time. Predatory lenders often target senior adults or low-income people by phone, mail, or in person. They have very high interest rates and excessive fees. Beware of credit repair services that claim they can erase your bad credit. If it sounds too good to be true, it's probably a scam. Guard your identity. Take the steps to guard your identity and never give out personal information over the phone, through the mail, or on the internet. Shred or destroy old bank and credit card statements and all other private records before tossing them in the trash. Give your social security number only when absolutely necessary. Let's make it a goal to be prepared for these emergencies and find ways to build emergency savings and build credit. Research shows that an emergency savings of as little as $500 can remove the need for most consumers to go to a payday lender. Building an emergency savings is a good first step in a building wealth action plan. If you're concerned about your credit and identity theft, Credit Freeze is an option that's now available. It was brought to you by a new federal law that began on September 21st, 2018. You're able to freeze and unfreeze your credit for free. It's also available for you to do year-round fraud alerts. You can find more information on this on the FTC Consumer Information blog, which can be found at www.consumer.ftc.gov.
As you build your wealth, it is also important that you protect it. What does that mean? Let's take a look at some of the basics. Insurance is an important part of your financial foundation that will help protect your wealth and assets. There are all sorts of different types of insurance for yourself and your property. Again, let's take a look at some of these. You have auto insurance. You must have liability insurance at a minimum to cover injury to other people or damage to their property. If you have a car loan, you might also be required to have physical damage coverage. There's home renters insurance. This protects your home and possessions in the event of fire or theft. Additional insurance may be required to cover flood, earthquakes, etc. Home warranty. This is an annual service contract that covers the repair or replacement of important appliances and system components that break down over time, such as heating, AC. A good action step to take every year is to review your property and auto insurance coverage and deductibles and premiums. It may be time to shop around and save on your monthly premium without taking on too much additional risk. When it comes to building wealth and working on your financial foundation, always take into account other types of insurance. And other types of insurance include health insurance, flexible spending account, disability insurance, life insurance, and long-term care insurance. With health insurance, you're required to have coverage by the Affordable Care Act. An important part of your work benefits compensations that can significantly help your budget. Then there's the flexible spending account, where you can save pre-tax dollars in an account to cover deductibles, co-pays, prescription and over-the-counter drugs, and other health expenses not covered by insurance. This does not roll over year to year and can also be used for childcare. Disability insurance helps if you're sick, injured, and unable to work for a long time. Life insurance, so in the event of your death, life insurance pays money to the person of your choice, your beneficiary. And long-term care insurance helps pay for health-related items like nursing home, assisted living, in-home care. All of these types of insurance are made to help protect you and the wealth that you have accumulated. We'd like to leave you with some important questions. So now that you've gotten an overview of building wealth, how has your definition of wealth changed? Are your financial goals still the same, or do you have some new ones? What strategies are you going to take? And what are your next steps? Here are some links to additional resources. You can find the Building Wealth curriculum on buildingwealth.org. Federal Reserve Education has some great webinars that you can take on finances. The Texas State Secretary's Board has some great resources on their site if you'd like to invest your money and how. BrokerCheck is a free tool that helps you make informed decisions about a broker or firm if you're wanting to invest. They provide information on a broker's employment history, licensing information, and more. Annual Credit Report offers yearly access to your report free of charge. You can view FICO reports through myfico.com. Federal Trade Commission has lots of resources on money and credit and expanding your wealth. If you're looking for information on how to freeze your credit, if you suspect identity theft or suspicious activity, check out this link on consumer.ftc.gov. And lastly, check out our blog, Plano Library Learns, for additional budgeting resources. You can use the term basic budgeting resources when searching our blog. This concludes our presentation. Thank you for taking the time to attend our virtual program on building wealth. Again, you can find more resources on our blog, planolibrarylearns.org, or our website, planolibrary.org.